What's going on, everyone? Welcome back to the channel. In today's video, we're going to break down supply and demand, explain how they differ from traditional support and resistance, how you can actually use these within areas of the market. We'll learn how to identify high quality supply and demand zones, and then we'll finish with a lower time confirmation entry that allows you to trade these zones with precision and confidence. When you understand these properly, you stop trading blindly and start positioning yourself on the same side as institutional players instead of going against them. But before we talk about supply and demand, we first need to start with the foundation: support and resistance. Support and resistance are price areas where the market has reacted before and is likely to react again in the future. These zones are created because of imbalances between buyers and sellers. For example, when price pushes higher, reaches a certain level, and then aggressively reverses, this area becomes what we call resistance. This happens because sellers step in with sell orders while buyers exit their long positions. That combination of selling pressure and long liquidation is what forces price to move lower. And on the flip side, when prices move down into a level and then strongly reverses to the upside, we label that area as support. In this case, sellers are closing their short positions while buyers are entering longs, creating the demand needed to push price higher. The opposing behavior on both sides of the market is what caused price to react from these levels. So, why do we even bother marking up these support and resistance zones? There are three key reasons. First, price memory. Levels that caused strong reactions in the past often cause reactions again. When price revisits these areas, we pay close attention to how it behaves. This is extremely useful for setting profit targets, especially when these zones come from higher time frames. A small reaction on a daily or 4-hour level can turn into a major move on the lower time frames. Second, directional bias. When price breaks and holds above resistance, it tells us buyers are in control and bullish momentum is present. When price breaks below support, it signals bearish strength. Identifying overall direction is the first thing you should do when you open up your charts before thinking about entries. Third, liquidity. Support and resistance zones naturally attract traders. Break and retest traders, range traders, and retail traders all look for entries around these zones. Most of them place their stop losses above the resistance or just below support. If the market lacks enough liquidity to move in the expected direction, price will often push through these levels, collect these stop losses, and then continue in the original direction. That's why these zones are commonly referred to as liquidity pools. Understanding these gives us an edge because instead of reacting emotionally at these levels, we can wait for price to show its true intention. That's why traditional support and resistance zones are not just reaction points, they are areas of liquidity. And this is where supply and demand concepts start to separate professionals from amateurs. Now, let's talk about what supply and demand actually means through a smart money lens. In smart money concepts, supply and demand zones are created when large players enters the market, causing price to move with speed and intentions. These zones are not formed from weak reactions or random consolidations. For example, we do not consider an area a demand zone if price simply taps it with several small candles and slowly moves away. That types of reaction usually signals indecision and not institutional involvement. A valid demand zone is formed when price leaves an area with strong bullish momentum, shown by large, impulsive candles. These momentum candles can suggest aggressive buying, which is typically driven by institutions, banks, hedge funds, essentially smart money entering the market with size. The same logic applies on the sell side. A valid supply zone forms when price drops aggressively from an area with strong bearish momentum, indicating heavy selling pressure from larger participants. So, how do we objectively measure how aggressive a move really is? We do this by identifying fair value gaps. A fair value gap appears when there is a noticeable imbalance in a three candle sequence, specifically the space between the wick of the first candle and the wick of the third candle. The larger the gap is, the stronger and more aggressive the price movement is. Fair value gap tells us that buyers and sellers were not operating at equilibrium. Instead, price moved so quickly that orders were left unfilled. This imbalance is a strong clue that significant capital has entered the market. Because of this, price will often return to these areas in the future to rebalance and fill those remaining orders, which is why fair value gaps are so important in smart money concept trading. There is one more key requirement that turns a supply or demand zone into a high quality level. And that's market structure. A strong move that breaks a previous structure level confirms momentum and direction. This structure breaks adds confluence and helps validate that the move wasn't random, but intentional. When supply or demand is aligned with a structure shift, it becomes far more meaningful for trading decisions. If you're not fully familiar with market structure or fair value gaps as of yet, I highly recommend watching our previous video. You'll find those linked in the description and in the top right corner. Now, let's talk about how to properly mark supply and demand zones. The first step is identifying a move that includes both a fair value gap and a clear structure break. Once we find a move that meets these requirements, we can define our zone. For a bullish setup, we mark the previous bearish candle that directly caused the fair value gap. We draw our zone from the high to the low of that candle because this is where institutional decisions were most likely made before price expanded higher. And for a bearish setup, the process is the same, just inverted. We mark the previous bullish candle that led into the fair value gap and use that candle as our supply zone. There are multiple ways traders draw supply and demand zones, and none are perfect. The most important rule is risk management. Your stop loss must be placed in a location that protects you from normal market noise while still invalidating the setup if you're wrong. That's how you use supply and demand the way smart money does. Not guessing, but reading attention. Now, when it comes to supply and demand in smart money concepts, we mainly focus on two types of zones, and both depend heavily on how market structure forms. These are order blocks and order flow. Let's start with order blocks. Order blocks are essentially refined supply and demand zones. They represent the specific candle where institutions initiated a strong move. For example, in this scenario, we see aggressive buying, clear fair value gaps, and a confirmed break of structure within the market. Now, this candle right here is the last opposite candle before price expanded aggressively higher. So, this is the candle we mark as our order block. Now, pay close attention to what price does next. Before the market takes off, it sweeps liquidity below this candle, triggering stop losses and trapping traders before moving higher. This brings up an important question. If we're planning to place a buy limit at this order block, where is the safest place to put our stop loss? The safest location is below the wick where their move originated, because if price breaks below that point, the setup is no longer valid. For that reason, we extend our order block to include this wick as part of the zone. From there, we wait patiently for price to retrace back into that area and look for trading opportunities when the conditions align. Here's another example. Once again, this candle is the final opposite candle that caused the impulsive move. And again, we see the same question. Where do we place our stop loss to avoid getting takeout by volatility? In this case, the safest area is above the swing high, so we include that as part of our order block zone. Now, this may result in a larger zone and a wider stop loss. But don't worry, later in this video, I'll show you how to refine your entry so you can reduce risk and enter at a more optimal price. Now, let's move on to the second type of supply and demand zone, which is order flow. But before we continue, if you're finding value within this breakdown, make sure to hit that like button. And if you're new here, subscribe to the channel. It really helps support the content. Order flow represents areas where buying or selling pressure was building up before the market made a strong impulsive move. In simple terms, it's where the institutions were positioning themselves before revealing direction. A bullish order flow is the last area of bearish pressure before price pushes higher, and a bearish order flow is the final area of a bullish pressure before price drops lower. These zones are extremely important in smart money trading and act as a major supply and demand areas. For example, in this move, price creates fair value gaps and breaks market structure. These candles here represents the final bearish momentum before the explosive bullish move. So, we mark this entire area as our order flow zone. Order flow zones are usually larger than order blocks and often contain the order block within them. There will be times when price reacts from the order flow area before reaching the order block. This can cause traders to miss entries if they are only focused on the order block. However, this is why understanding market structure and context is crucial for execution. When you combine order block, order flow, and structure, you stop chasing trades and start letting price come to you. Now, let me walk you through one of the most effective ways to trade supply and demand, while also improving your entry price and managing risk properly. The first rule we need to follow is risk to reward. We only consider a setup that offers a minimum of a 1 to 2 risk to reward ratio before price reaches our first objective. If the setup doesn't meet this requirement, we simply ignore it. Our initial target is always the most recent high that price has created, because this is the nearest logical area where price may react or slow down. Once we've confirmed that the setup offers enough reward, we wait for price to retrace back into our supply or demand zone. And at that point, we don't enter blindly. Instead, we look for our confirmations on the 1 hour time frame. What we want to see is a clear rejection candle forming on the 1 hour chart from our zone. This rejection shows us that price is respecting the level and smart money may be stepping back into the market. After that 1 hour rejection is confirmed, we then scale to the 15-minute time frame to fine tune our entry. And on the 15-minute chart, we have two main options for confirmation. We can either wait for a fair value gap to form, or we can enter after a strong bullish candle closes, signaling continuation from that zone. Once our entry is confirmed, we place our stop loss below the low of the 1 hour rejection candle because a break below that level will invalidate the setup. For our take profit, we target the nearest swing high on the 4 hour time frame, as this is a higher time frame objective and a logical area for price to react. This approach allows us to enter with precision, reduce unnecessary risk, and trade supply and demand with structure instead of emotion. Now, let's go through another example, but this time we'll be looking for a short trade. On this chart, starting with the 4 hour time frame, we can clearly see a break in market structure to the downside. During that move, price leaves behind a well-defined bearish order block, which gives us our area of interest. From there, we stay patient and wait for price to retrace back into this zone. And once price taps the area, we shift our focus to the 1 hour time frame. And then we wait for a clear rejection to form. This rejection confirms that sellers are stepping back in and that the zone is being respected. After the 1 hour rejection is established, we then drop down to the 15-minute time frame to refine our entry. On the 15-minute time frame, we look for our entry confirmation, such as a reaction candle or an imbalance forming in the direction of the trade. Once the entry is confirmed, we execute the short position. For our target, we aim for the most recent swing low on the 4 hour time frame, since that's the nearest higher time frame objective and a logical place for price to react. This process keeps our entries precise, our risk controlled, and our trades aligned with the higher time frame structure. And that wraps up today's video. Remember, supply and demand isn't about guessing. It's about waiting for confirmation, trading with structure, and managing risk properly. Do that consistently and your edge becomes clear. If you found value, like the video, subscribe for more smart money breakdowns, and drop a comment if you have any questions below. This is the Trading District, and I'll see you in the next one.